Hello and welcome back to another episode of How to Invest $10,000, the weekly series where I invest $10,000 into stocks, real estate, or really anything I see fit with the goal of trying to grow the portfolio as quickly as possible while maintaining a low to medium risk profile. So basically the same as I do with all my other investments. So before we jump into our first segment this week, I want to hurry and show you guys where the account is currently sitting at right now. As you can see, it is sitting there at $99.6632 currently on our Robinhood account. And just to give you guys a little bit of background, a little bit earlier this week, we had actually reached $10,102 as a new high of the account. So today is actually Monday, July 11th, and so the stock market was open today, and one of our largest positions, Tesla, took about a 5-6% loss today. So because of that, we did actually see our account come off of our all-time highs, but hey, that's just investing for you. So with that introduction out of the way, let's go ahead and jump right into our first segment, weekly moves. So very first thing that I want to hurry and talk about is that I actually had adjusted the amount that we are doing on our recurring investments into our very favorite stock, our high conviction stocks that we're trying to dollar cost average into. So now every single day we will be buying this much of each of these individual stocks. First of all, we are going to be buying $15 a day of AMD, $10 of Google, $10 of Microsoft, $5 of Nvidia, $30 of Tesla every day, and $3 of Bitcoin. So now that we've covered that, let's go ahead and jump into what the actual individual trades were that we had made during the course of this last week. First of all, we had bought $40 worth of Tesla on July 5th, followed by $50 of TQQQ, which is basically our leveraged total broad index of the NASDAQ that we've been trying to dollar cost average into, and then $40 of AMD on the 5th as well. Moving to the 6th, I bought $25 more of Tesla and $25 more of TQQQ. And then on Friday, I got a little bit excited and bought a full share of Tesla at $7.62. And obviously today, with the stock closing down near $7.02, that wasn't the very best trade to have made. But nonetheless, I really don't mind buying that extra share of Tesla, as in my opinion, I feel like Tesla is actually poised to possibly get up to the around $787 or right around $800 range if we come in at expectations with our earnings report that's going to happen on July 20th for Tesla. In my opinion, if we keep trading at the current multiples that Tesla has been trading at now for a while, and we hit that $1.90 EPS for the quarterly Q2 earnings report, I think that we could see Tesla potentially run up to about $787 a share, possibly even $800 a share. And so I was going to hurry and mention, now with purchasing that last share of Tesla at the $762, that brings our average cost on our Tesla position to $732.48. Technically, total return, we are down 4% in our Tesla position, and we own 1.62 shares with our full share that we had bought on Friday, plus the dollar cost average position that we had built so far. From this point forward, now that we have a pretty good position established in there as far as how much of the portfolio is actually going towards Tesla, I think I'm just going to mostly dollar cost average into them from here. And of course, if we have opportunities, especially if we see Tesla back down into the 600s, which is entirely possible, then I'll probably wind up putting in a little bit of extra money in with partial shares along the way to kind of speed up our dollar cost averaging. But for now, I'm pretty happy with where our Tesla position is at. Just to give you an idea better of where we are on all of our positions, right now we own about 0.18 shares of Nvidia, 0.03 shares of Google, 2.13 shares of AMD, 7.3 shares of TQQQ, and 0.11 shares of Microsoft. So yes, we are slowly getting into our positions here on stocks. As far as our Bitcoin position goes, we own very little of Bitcoin. I think as far as a dollar amount of Bitcoin, we own $25. So yeah, slowly putting in some money into Bitcoin, but right now with things going on in the crypto space, I'm definitely not super bullish there in the long or short term. It's more of a speculative play in my opinion right now until we start to get some regulation in the crypto space. So yeah, that kind of sums up what we have done this week as far as moves in the portfolio between changing up the recurring investments as well as the small little trades that we made and buying the bigger share of Tesla that we had made on Friday, which wound up to be a little bit of a mistake, but hey, you can't always be perfect. And it kind of acts as an insurance policy that if our earnings do wind up going well on Tesla, then well, we're going to be there with a little bit more market share to enjoy the ride up to 787, possibly even 800. All right, so with all those trades now summed up, let's go ahead and move into our very next segment, the news recap. Okay, so very first thing that I want to go ahead and mention is that on Tuesday, we wound up actually seeing the yield curve invert again for the third time now this year, ladies and gentlemen, and we still have people that are naysayers saying that we aren't going to actually see a recession anytime soon. In my opinion, I think that we are definitely inevitably going to be seeing a recession, and if you'd like to see my full detailed video as to why I believe that, I'll go ahead and leave a card up in the corner of this video so you can check that out. But to give you a basic understanding of what the yield curve inversion basically means is that every time that we've ever had a recession in our past, we have seen the 10-2 yield curve invert, where basically if you were to take the 10-year treasury bond and minus off the 2-year treasury bond, if the 2-year treasury bond is larger than the 10-year, then you're going to have an inversion, right? So usually, historically rather, then every time that we see that happen and that inversion actually occurs, shortly after we tend to get a recession. I'll hurry and make sure that we put a chart on screen for that so you can see what I'm talking about. But this has now happened 3 times this year. So not only have we had an inversion once, not twice, but 3 times. So this is looking worse and worse as far as recession fears go. Now, after that, on Wednesday, we had the JOLTS report come in, and we were expecting 11 million new job openings to be there, and we wound up actually getting 11.25 million jobs that were open. So that came in a little hotter than expected, and truthfully, what that's going to do is it's going to signal to the Fed that they have more room to tighten. So obviously, we have been kind of expecting a 0.75 basis point hike to happen in July. But, a strong JOLTS report like that, it's just going to add even more pressure to the Fed to say, hey, you're good to go ahead and give us that 75 BP hike on this next interest rate decision. On top of this, on Wednesday, the minutes of the Fed FOMC meeting for June came out. And basically, inside those minutes, we got even more confirmation that we're going to be getting a 75 basis point hike in July. They literally said that on the very first page of the report. And then as we get into page 9 of the FOMC minutes, then basically you had a couple of more statements made in there. There was a broader base statement that I'll hurry and make sure I put on screen where they kind of beat around the bush of inflationary fears, talking about how a lot of the participants in the FOMC kind of had a little bit of a unclear outlook of what GDP performance might be over the next couple of years. And in my opinion, I think that was their way of kind of beating around the bush of recessionary fears, right? And on top of that, on page 9, then they also talked about their credibility and how so far their credibility has done very good work for them in the midst of basically the bond market being able to elevate the 10-year yields and different treasury yields in the markets, which helps them counter inflation by basically when those yields go up in the treasury markets, it makes lending more expensive at banks and it affects mortgage rates and different things like that. So when we start to see the bond market sell off and yields increase, it actually winds up doing some of the Fed's monetary policy for them. So they talked about how that has been very helpful, but then farther down on the page, they actually talked about how that is also going to kind of pose a risk for them to where if they start to lose credibility from the markets and from investors, then all of a sudden that might start to backfire as if people start to imagine that they might, loosen up on some of their policy. And actually later on in the week, we started to see the bond market actually rally a little bit. So that bond market rally is even more proof to the Fed that, yeah, you're good to keep on raising rates even faster, helping to tighten up monetary policy in the U.S. All right, now moving on to Friday, we got our jobs report. We added 372,000 jobs, which is, again, hotter than expected. And wages increased at a pace of 5.1% as well, which is also faster than the consensus, not by much. The consensus with 5%, but 5.1, still it's enough to kind of cause some concern, especially since wage inflation is one of the things that's going to contribute the most to seeing higher inflation on our CPI reads and PCE reads, right? So, the Fed is definitely not going to like that we're even coming in over estimates. If anything, they wanted to see that come in below estimates. And not to mention that 5.1% wage inflation, that's definitely not a good sustainable rate that we want to be seeing wages growing at. I mean, wage inflation is definitely a good thing. People deserve to be being paid more and different things like that. But as far as what the Fed is looking at and their objective of trying to bring inflation down, seeing a high wage inflation rate is definitely going to make them go, hey, we need to be doing more and more of these higher basis point increases at their meetings and at our interest rate decisions. And basically, the jobs report was another indicator to tell the Fed, yeah, go ahead and do that 75 basis point hike. And then last but not least in the news recap, we continue to see Bitcoin stumble around that 20,000 mark. Yeah, I think it rallied up to about 22,000 for a little bit, but really it just continued to stumble around the 20K mark. And, that's really not surprising since we continue to see more and more of these crypto firms and crypto hedge funds, if you will, go under and see different issues as far as how they've been lending out people's crypto. And, it's kind of actually sad to see how many people might not be able to get some of their money out of these firms as a lot of them put their faith into it when really it wasn't the best place to be putting your faith into. But when there's a high yield interest rate like there was at some of these firms, then, people just look at that at face value and go, hey, I can be earning an easy 12% on my money here. So go ahead and I'll stick my crypto in there with you guys so that way you can keep it safe. And unfortunately, a lot of these guys wound up not doing that and taking advantage of their customers. So basically, to sum up what the news means for this week, everything between the JOLTS report and then the jobs report that came out on Friday with faster than expected wage inflation, just more ammunition for the Fed to latch on to give them incentive basically to continue with these 75 basis point hikes. So it's looking more and more like in July, we're going to be getting the 75 BP once again, just like June. But anyway, guys, that is the update on the $10,000 account. Thank you again so much for checking in on this second episode of how to invest $10,000. If you're liking the series so far, let me know down below in the comments section. If you want to make sure that you're here for every single weekly episode of investing $10,000, make sure you hit that subscribe button down below. And also, if you wouldn't mind, please hit that like button down below, as it does help this video find more people that are interested in investing content such as this. So anyway, guys, until next week and next episode, we'll see you next time.